If you want to learn how to value a company, the very first thing you should do is take everything you know about stock charts, ticker symbols, and flashing red and green numbers and just erase it from your mind. Instead, we are going to look at something much closer to home. Imagine your neighbor, a kid named Tommy, sets up a lemonade stand at the end of your street. Tommy walks up to you and makes a pitch. He says he will sell you exactly half of his entire lemonade business for $50. If you say yes, you get to keep half of all the profits that stand makes, forever. So how do you decide if $50 is a fair price? You could go ask the other neighbors what they think the stand is worth today, but that is basically just guessing. To really know, you have to roll up your sleeves, look at how many cups he sells, taste the lemonade, and count the foot traffic. When you do this homework to find the business's true value, its intrinsic value, you're performing what professionals call fundamental analysis. It's the art of knowing exactly what you are buying so you never overpay. To figure out if Tommy is running a tight ship, you ask to see his records. In the adult business world, every public company is required to publish these records every few months. Think of them as 3 magic notebooks. Let's look at this layout for the first notebook, the income statement. This shows you exactly how much money the business makes. We can see Tommy brought in $100 by selling 100 cups of lemonade. That is his revenue. But he also spent $30 on lemons, 10 on sugar, and 10 on cups. Taking that $50 in ingredient costs away from his $100 in revenue leaves him with exactly $50 in profit. You can clearly see the stand actually makes money. Next is the balance sheet. This one acts like a frozen snapshot taken at a specific second in time. It simply lists the physical things the business owns, right alongside the debts it owes to other people. Think of Tommy's balance sheet like a backpack. Inside, he holds $35 worth of physical assets, like his folding table, a pitcher, and a little cash in the box. But he also carries a debt. He owes $15 to his mom for buying the table. Subtracting that debt from the assets leaves $20 in equity. If he shut the stand down today, paid his mom back, and sold his supplies, that $20 is what he'd have left over. The final notebook is the cash flow statement. Sometimes standard accounting rules can make a business look richer than it actually is. This statement strips all of that away to look at the cold, hard cash moving in and out of the piggy bank. For instance, Tommy might claim $50 in profit, but what if he let his friends take 30 cups of lemonade on an IOU? He hasn't actually collected those dollars yet. The cash flow statement tracks what is physically sitting in his pocket right now. Reading all 3 of these notebooks together gives you the complete picture. It stops you from buying into a business that looks successful on paper, but in reality has completely run out of cash. Beyond the math, businesses are run by real people in an unpredictable world. This is where you look at the human side of things, called qualitative analysis, where you judge the parts of the business that a calculator can't measure. You start by looking at management. Is Tommy an honest kid? Does he wake up early and work hard, or is he always late? When you buy real stocks, you ask those exact same questions about the CEO. Then you look for a moat. A castle uses a moat to keep enemies away, and a business uses one to keep competitors away. If Tommy uses a secret family recipe nobody else can copy, or if his stand is located right next to a busy, hot basketball court, those advantages act as his moat. You also have to zoom out and look at the broader trends. Selling cold drinks in the sweltering heat of July is a great position to be in. Trying to sell them in the freezing middle of January is a terrible one. If a business doesn't have a reliable moat to protect its profits, it wouldn't matter how good its notebooks look today. Sooner or later, competitors or changing trends will chip those profits away. Let's bring this all back to Tommy's offer. We know the stand is making money, and we know he has a great location, but we still need to figure out if $50 is actually a fair price for half of the operation. To do the math, we use earnings per share, or EPS. We divide the total profit equally among every slice of the business. If the business made $50, each of the 10 slices earned $5. Now we look at the price. Tommy is asking $50 for 5 slices. That means one slice costs $10. Divide that $10 price by the $5 earnings, and you get the price-to-earnings ratio, or PE. It's essentially a timer showing how long until the business pays you back. In this case, a PE of 2 means it will take exactly 2 months of standard profits for you to earn your entire investment back. Knowing this ratio lets you spot a bargain. A lower PE means your investment pays for itself faster, which is exactly the kind of deal you're looking for. You've completed your investigation. The notebooks show a healthy profit, the location provides a strong moat, and the math proves the price is right. Because your work shows the true value of the stand is much higher than the $50 Tommy is asking for, you can confidently shake his hand and make the investment. This exact same framework, the same one you just used for a lemonade stand, is the core strategy of the world's most successful investors, like Warren Buffett. He applies this logic to massive global companies like Coca-Cola, looking for that same combination of strong notebooks and a protective moat. The philosophy is simple. Ignore the noisy charts, read the financial notebooks, find the moat, and wait to buy a piece of the business for less than it is worth. By breaking down the business step by step, you've used the same analytical tools that Wall Street professionals use to build lasting wealth.